Here at What's the Difference, we helped you go from not having a clue about what is going on in the world of finance to sounding like an expert when discussing monetary policy. Well, today, I'm here to define the distinction between the Treasury and the Federal Reserve. Why, you ask? Because it is important to know, especially if you are a bank customer and savers. Let me begin by stating that their roles are completely different. On one hand, we have the Treasury, who acts as a government employee, and on the other hand, we have the Fed, who is more like a government-sanctioned bank. So, riddle me this. What's worse than an organization that can create money at will? How about a group of groups who can create money at will? If you've never made the distinction, or even heard of the distinction between the Fed and the Treasury, then this video will clear things up for you. What's the difference between the U.S. Treasury and the Federal Reserve? Separate entities. The U.S. Treasury and the Federal Reserve. The Treasury is responsible for managing all of the money that the government receives and expends. The principal role of the Federal Reserve is to maintain a steady supply of money in the economy. Federal spending is overseen by the Treasury Department. All of the tax income and budgetary funds of the government are collected and distributed by the central bank. It also creates government bonds, notes, and bills. Cabinet-level appointees serve as Treasury Department heads and provide the president with monetary policy advice. The Federal Reserve, the country's central bank, is governed by a board of governors who are responsible for the Federal Reserve's 12 regional banks. One of its principal objectives is to oversee the nation's private banks and manage the total money supply in order to maintain a stable inflation rate and a stable employment rate. Not the president, but the United States Congress holds the Federal Reserve Board of Governors accountable. Important lessons to learn. The United States Treasury is most recognized for printing money, literally, and providing economic advice to the President of the United States of America. Credit and loans are made available to lenders and borrowers by the Federal Reserve, which serves as the nation's central bank. The two work together to keep the economy healthy and raise money for the government when it needs it. Recession fighting and bailing out institutions are aided by these two. The U.S. Government's Central Bank. The Treasury Department was founded in 1789, making it the more established of the two. When it was first formed in 1789, Alexander Hamilton served as the organization's inaugural secretary. This position's principal responsibility is to advise the president on domestic and international economic matters, as well as to carry out his or her economic policy recommendations. Aside from tax collection and revenue management, the IRS's official mission is to serve and strengthen national security by managing the U.S. government's finances effectively, promoting economic growth and stability, and ensuring safety, soundness, and security of both the U.S. and the international financial systems. In other words, $54 billion. The Federal Reserve's anticipated 2019 payment to the Treasury of the United States. In order to achieve its goals, the Department of the Treasury consults with the President and other government agencies, such as the Federal Reserve, to promote global economic growth, enhance living standards, and to the degree practicable, foresee and avoid economic disasters. The U.S. Mint, which prints and mints the country's currency, is part of the Department of the Treasury, as does the Internal Revenue Service. Even the Treasury is a treasury in its own right. Most of the country's gold is kept in a vault at the Federal Reserve Bank of New York. Treasury and Federal Reserve functions overlap in this instance. The U.S. Central Bank. Due to a growing belief that the U.S. financial system was being dominated and used by a few banking firms for their own profit, the Federal Reserve System was established in 1913. Interest rates on Treasury notes, bonds, and other Treasury-issued debt are among its most visible responsibilities. The Federal Reserve's decisions directly affect interest rates for both consumers and companies. With its lending and borrowing policies, the Federal Reserve seeks to stimulate or calm an economy that is either stagnant or overheated. Inflation and unemployment can be kept under control by striking the correct balance. It is ultimately a matter of ensuring the financial well-being of both the lenders as well as the borrowers. Federal Reserve banks are likewise under the watchful eye of the Fed and are subject to regulation. No one owns or benefits financially from the Federal Reserve, which is a commonly posed question. American financial institutions benefit from the government's non-profit organization. Differences in focus. In order to keep the American economy steady, the Treasury Department and the Federal Reserve work together. As the government's bank, the Federal Reserve processes transactions. Electronic payments for Social Security taxes and payroll checks for government employees are only two of the many services that the federal government provides. When the government needs money, the Federal Reserve and the Department of the Treasury work together. Treasury securities auctions are handled by the Federal Reserve on behalf of the Department of Treasury. Treasury securities include, but are not limited to, Treasury bills or T-bills, bills of exchange, and Treasury documents. Securities issued by the federal government that are guaranteed against inflation. Another way in which the Federal Reserve and the Treasury Department are linked: Federal Reserve Bank of San Francisco is a non-profit. Profits that remain after expenses have been paid are given to the Treasury Department. After the Treasury Department receives the money, it utilizes it to pay for government programs, one that generates a significant amount of money. In 2019, the Federal Reserve is expected to make a $54.9 billion contribution to the Treasury. So, the Federal Reserve serves as the government's bank and creates a percentage of the revenue utilized to fund the nation's activities, as well as making and implementing policies. Considerations for defending the economy in the face of a downturn. When the going gets bad, these two organizations work together to develop and implement economic policies that lower interest rates and increase the amount of money accessible to banks and consumers. When the Treasury Department decides to grant tax rebates, it is in charge of withdrawing funds from the Federal Reserve and distributing them to taxpayers. The money is then spent by the people who are buying the products. Through their spending, they contribute to the growth of the economy and the creation of new jobs in the production and distribution of consumer goods. Financing corporations. Government-sponsored firms like Fannie Mae and Freddie Mac may also benefit from joint efforts by the Federal Reserve and the Treasury Department. At a discounted rate, the Federal Reserve is able to lend money to these companies when they run into financial difficulties, while the Treasury Department can raise the line of credit available to the companies and even buy their stock shares. Additionally, they can aid non-governmental organizations. One such example is the 2008 collapse of the financial bank Bear Stearns. Bear Stearns was purchased by J.P. Morgan for $29 billion by officials from both institutions. While the Federal Reserve was the driving force behind the bailout, the Treasury was on the hook for any losses. In 2001, the airline industry received a government-sponsored bailout, as did the savings and loan industry in 1989, and Chrysler Corporation in 1979. Federal Reserve and Treasury are two independent agencies, yet they work together closely. Fiscal stimulus is used by the partnership to alleviate the economy's downturn at the macro level. When applied on a small scale, it can be used to cushion the blow of failing businesses on their employees and the economy as a whole. In this way, the financial well-being of the United States is protected by both organizations. To sum it up, we can think about it this way. Treasury's purpose: to ensure that enough cash is available to pay the nation's bills and protect public trust in the currency. The Fed's role: to provide an elastic currency, maintain stability of prices, and minimize fluctuations in the interest rate. In the end, both federalreserve.gov and treasury.gov had what I needed, and they both educated me to a much greater degree than I had initially assumed. However, at the end of it, it's important we understand that when it comes to your cash, you always have access to information on how it's being handled. In today's digital age, that is a good thing. And remember, if you want yourself or your kids to stay away from a lifetime of debt and interest payments, put the money in T-bills first. This, of course, is not financial advice. Seek a professional financial advisor for more advice on how T-bills can work for you in your investment portfolio. Were you aware of the distinction between the Treasury and the Fed? Do you have any additional information that others should know about this topic? Let us know in the comments section below or join the conversation on Twitter. Be sure to like and subscribe for more content to transform into smart money.